Hi, I'm Jim Juback, and welcome to this week's YouTube video. Baseball season is over, although last Saturday, the day the World Series would be ended on that evening, I went out for a mushroom walk in Inwood Park, which is at the northern end of Manhattan, and had the lovely experience of there are ball fields at Inwood Park, and it was apparently the playoffs for the Inwood Little League. It's founded in 1950, and these were 16 and 7-year-old kids. It's largely a Dominican neighborhood. They take their baseball very seriously. And I was watching this 16-year-old catcher warm up, and he was just taking short throws behind home plate, and then jumping up from his crouch and practicing throwing runners out at second and third, because this is a league that allows stealing. And his problem was, I would have thought, it's a long throw, 90 feet. His problem was he was throwing the ball over the head of the third baseman. So he gradually worked it down. Elevation was the issue. So by the time they're ready to start, he was coming in at the right height. Anyway, if you want more of my financial stuff, not more baseball stuff, go to my free site. That's jubackpicks.com. 3 portfolios online. You can go to my paid site. That's jubackam.com. That's got 6 portfolios, including ETFs and some options and some inverse ETFs for this bear market. If you like this video, please give us a thumbs up. Subscribe to my YouTube channel. That way you get notification of when we do the next one, because we're doing about 3 a week, but not always on the same day. Anyway, today's topic is capital cycles and recession. And I think it's really important right now to realize they're not the same thing, that we're focused very much right now on the possibility of recession. And when we talk about recession, we talk about largely a consumer demand recession. That's what the Fed is trying to produce by raising interest rates, and demand will go down as more people get out of work. But there's also a sort of recessionary part of the capital cycle. When money is cheap and plentiful, companies borrow and they invest. And gradually, if the sort of cheap money part of the cycle lasts long enough, they get kind of sloppy. They start to invest in things that really they shouldn't invest in because the returns aren't there. And the recessionary part of the capital cycle is where capital starts to get more expensive and companies start to go, oh, we really don't need that warehouse, or, oh, that project we're investing in really doesn't have anything like the return on invested capital, ROIC, that we're looking for. And we can see this happening now. It's happening really, really visibly in the tech business, where it's hitting small companies really, really hard, but it's also hitting big companies. And if you look at Meta platforms, basically Meta is looking at trying to cut costs, because one of the things it's doing is looking at the ROIC of its products and saying, hey, return on these products are really far down the line. Our capital costs are rising. And one of the way their capital cost is rising is the stock price is going down. So if you want to look at what that means, here's the Meta Platforms chart. And as you see, way back on the 25th, we were 137, and then we just fell off a cliff and we're down at 96 today. That's of concern, of interest, not only to people who own Meta stock, but also to Meta itself, because this is a way that Meta raises capital. And if you're investing right now and you're not making a lot of money, you care about what your capital costs are going to be. Another example is Amazon. Amazon, I think, got really sloppy during the cheap money cycle, investing in things that just because they could. And you're starting to get a fair amount of criticism. This is an Amazon chart. We're going from, again, around the 25th, 120 down to 90. One of the larger issues is Amazon is looking at its demand forecasts and going, hey, we don't think we're going to need all those warehouses we contracted for. So they're getting rid of some of those contracts, getting rid of some of those warehouses, cutting back on the speed where they're adding new warehouses. But the other thing is they've been taking a fair amount of, and this is new, criticism on Wall Street about where they're putting their money. And Wall Street investors are going, okay, if you've got a company like AWS, they're a cloud server industry, why are you investing in anything else? Because, hey, putting money into Whole Foods right now where you're making 5% on your money doesn't make any sense when you got AWS as a place to put money. So they're starting to get some pushback from that. This is a large and regular part of the capital markets process. It's how the capital markets allocate money. The problem is that if you've had a long period of very, very cheap money, which we've had, capital allocation has gone kind of haywire. Money's been too cheap for too long, and now we're getting some unwinding of all this. It's something to look at because it's really a different issue than just the recession, although the recession feeds into it. But we are looking about reevaluation of businesses. I would look right now at companies that are pretty good at this as opposed to companies that have gotten a little loosey-goosey about this. So Microsoft, which had a big lesson on how to do this when they had to figure out what to do with all of the returns from the cash part of their business from Excel and Word, gotten pretty good at that. Another company I'd look at that's really good at that is Cummins, which is an entirely different field. They make diesel truck engines, but also increasingly making hydrogen-powered truck engines and electric truck engines. I think they're really good at trying to figure out where the profit margins are and what kind of scale they need. So I'd be looking for companies like that in this particular environment and watching out for companies where basically they're used to spending a lot of money because, hey, money was cheap. Thanks very much for watching. If you've enjoyed this video or just liked it, subscribe to my YouTube channel. That way you get notification when we're doing our next videos, doing about 3 a week. You can get more of my stuff, including portfolios that include Cummins, no Meta, and some Amazon on my free site, jbackpicks.com. And there's my paid site, which is jbackam.com, and that's got 6 portfolios, including some ETFs and options and inverse ETFs for the bear market. Thanks very much for watching.